Listen, if you're planning to move to Florida or Texas after retirement just to save a little on state income tax, I want you to stop right now. Because I've seen too many smart people who've managed their finances carefully their whole lives only to fall into this biggest cognitive trap in the end. They're so fixated on no state income tax that they end up spending several times more each year on property taxes, home insurance, and sales tax than they save in taxes. What's even more counterintuitive, some states, like Pennsylvania, have state income tax. Yet they might actually be cheaper for retirees than Florida. You heard that right? Today, we're not talking about feelings. We're redoing the math. I'll give you the latest 2026 good and bad list of retirement destinations, revealing which 3 states are stealing your pension and which 5 are the true value champions. More importantly, I'll tell you about a $6,000 senior bonus deduction that just took effect in 2026, and most people have no idea it exists. Moving is a major life decision. Don't let a clickbait headline about tax rates ruin the rest of your life. Let's start by breaking down a core principle. Many people's eyes light up the moment they hear a state has no state income tax. I completely understand. Who wants to part with their hard-earned money? But the problem is, state governments aren't charities. If they don't collect income tax, where do they get the money to build roads, hire police, and pay salaries? The answer is simple. They'll recoup the costs through your property taxes, your spending, and your insurance premiums. This is what behavioral finance often refers to as the framing effect. People only see the prominent income tax box, while overlooking the much larger boxes of property taxes, sales taxes, and insurance premiums. Here's an example. You move to Florida and save $5,000 in state taxes, feeling pretty pleased with yourself. But you don't realize that your home insurance premiums have skyrocketed from $1,200 in Ohio to $8,000 on the Florida coast because of hurricanes. Because you're constantly teetering on the edge of your insurance company going bankrupt. So, did you gain $5,000 or did you lose $1,800? That's why today we have only one criterion, total cost of retirement. Put your pension, 401k, EIRA, Social Security, property taxes, insurance, and healthcare costs all into an Excel spreadsheet and calculate the total. Remember this, in retirement planning, the most expensive thing is the free state tax break. Alright, now let's call out the names. Unless your children and grandchildren all live there, I really recommend you think twice, and then think again about these 3 states. Number 3, Vermont. Vermont is picturesque, but its tax laws are extremely unfriendly to retirees. It has the lowest Social Security tax threshold in the country. Can you guess how low? If you re-single and earn over $50,000 a year, the state government starts taking a bite out of your Social Security benefits. At the same time, your retirement income, including your pension, 401k, and IRA, can be taxed at a rate as high as 8.75%. Don't forget the 16% flat estate tax. This means that if you want to leave something to your children, the government takes a big chunk first. It feels like raising a pig all your life only to have the butcher say, "This half is mine," when it's time to slaughter it. Second place, Minnesota. Minnesota is a great place, but its taxes are really high. It imposes a tax of up to 9.85% on your retirement income. Plus, as long as your income exceeds $84,000, you'll have to pay taxes on your Social Security benefits too. It has an estate tax with a $3 million threshold. Many people think, that doesn't apply to me. But hold on, for many retirees, a house and a 401k account combined can easily push you over that line. You might think you're just an average person, but in the eyes of the state government, you're already a high net worth individual. But do you think these 2 are the worst? The real villain is number 1. Number 1, California. I know. Many people will say, California has great sunshine and a pleasant climate, but the price you'll pay for this pleasantness is far beyond what you can imagine. First, while it doesn't tax Social Security, it taxes all other retirement income. Your pension, your 401k, your IRA, your annuity, as ordinary income. What is the top tax rate? 13.3%. Imagine withdrawing $50,000 from your IRA to improve your quality of life, only to have $6,650 go straight into Sacramento's coffers. Does that hurt? It doesn't end there. In addition to high housing prices, California's home insurance market is in crisis. With wildfires on the rise, insurance companies are pulling out, and the remaining premiums are doubling or even tripling. The small benefit you save from no Social Security taxes won't even make a ripple here. In short, unless you're a billionaire who couldn't care less, retiring in California is a shredder for your pension. Alright, enough with the scare tactics. Does that mean tax-free states are your only option? Don't worry, the following 5 states are the real hidden gems, especially number 3, which is definitely a massive blind spot. Let us see which places are truly worth entrusting the rest of your life. 2. Number 5. Iowa. Iowa is the Midwest's hidden dark horse. Starting at age 55, all your retirement income, Social Security, pensions, 401k SIRS is completely tax-free. All of it. Plus, starting in 2025, they've eliminated the estate tax. The downsides are also clear. The winters are so cold, they make you question your existence. Property taxes aren't exactly low, around 1%, and outside of major cities like Des Moines, healthcare resources are fairly limited. If you're in good health and don't mind the cold, Iowa is a great place to save on taxes. Number 4. Nevada. Nevada has no state income tax, no estate tax, and no inheritance tax. Property taxes are the 3rd lowest in the US at just 0.47%. If you enjoy gambling and the outdoors, this place is practically paradise. However, there's a huge but. Nevada's healthcare system ranks 35th in the nation. Very low, the doctor-to-patient ratio is low, and specialists are even harder to find. If you have long-term medical needs in retirement, such as managing chronic conditions or requiring frequent visits to cardiologists or orthopedists, Nevada could be a major headache. The money you save on taxes might end up being spent entirely on plane tickets to seek medical care in other states. Number 3. Pennsylvania. This is definitely today's biggest mind blower. Listen carefully. Pennsylvania has a 3.07% state income tax, right? Many people hear that and immediately cross it off their list. But the truth is, this 3.07% tax rate doesn't apply to any of your retirement income at all. Let me repeat that. Your Social Security, your pension, your 401k, and your EIRA withdrawals. This state only taxes your earned income or returns from non-retirement investment accounts. For the vast majority of retirees, this means your state tax bill in Pennsylvania is 0. Isn't that crazy? A tax state is for retirees effectively the same as a tax-free state. What about the downsides? Property taxes are relatively high. Also, Pennsylvania has a somewhat troublesome estate tax, 4.5% for children and 12% for siblings. This requires some estate planning to avoid, but the pros far outweigh the cons when it comes to day-to-day cash flow. Pennsylvania is the undisputed champion. Number 2. Tennessee. Tennessee is another state with no state income tax, no estate tax, and no inheritance tax. Property taxes are extremely low at just 0.56%. The cost of living is 7% below the national average. Music, great food. The Great Smoky Mountains, retirement here. Sounds perfect. Where's the catch? On your shopping receipts, Tennessee has the highest combined sales tax rate in the country, at 9.6%. Even worse, it imposes a 4% tax on groceries, the milk, bread, and eggs you buy at the supermarket. What does this mean? Every single purchase you make, day after day, week after week, is being drained by an invisible tax. For retirees with lower spending habits, the burden of this sales tax may far outweigh the small amount of income tax you save. It will quietly eat away at thousands of dollars of your cash each year, like a frog in slowly heating water. Number 1. Florida. Yes, it's Florida again. Even though I mentioned its insurance issues at the beginning, it still ranks first. Why? Because its advantages are too strong. No state income tax, no estate tax. More importantly, It boasts the most comprehensive retirement infrastructure in the nation, countless 55-plus communities, a top-tier healthcare system, and countless affordable or free recreational activities. Plus, Florida law protects homeowners with a 3% annual cap on property tax increases. Save our homes, meaning you don't have to worry about skyrocketing property taxes forcing you out. But you must face its fatal flaw: home insurance. It has the highest insurance premiums in the country, averaging over $7,000 annually, easily exceeding $10,000 in coastal areas. And that's on top of expensive flood insurance. To make things clearer, let's run a real-life calculation. Consider a retired couple. They receive $72,000 in pension income, $24,000 in Social Security, and $15,000 in IRA investment income annually. In California, they would pay taxes on $87,000, pension plus IRA, amounting to approximately $7,200 in state taxes. In Pennsylvania, they would only pay 3.07% tax on their $15,000 in investment income, which comes to $460. They wouldn't pay a single penny in taxes on their pension. In Florida, state taxes are a perfect $0. Looking at taxes alone, Florida wins, right? Now, let's factor in home insurance. They own a $350,000 home in Pennsylvania, with annual home insurance costing $1,400. They own a home of the same value in Florida, but annual home insurance costs $7,800, plus an additional $1,000 for flood insurance. Total cost in Pennsylvania: $460 in taxes plus $1,400 in insurance equals $1,860. Total cost in Florida: $0 in taxes plus $8,800 in insurance equals $8,800. To save that $460 in taxes, you have to pay nearly $7,000 more in insurance premiums every year. And that doesn't even account for potentially higher utility bills and more expensive car insurance in Florida. So, do you see the picture? Moving to Florida for so-called tax-free living is actually the most costly decision you could make. Now that we've covered the financial aspects, let's look at the timing. In 2026, 3 tax changes will directly impact your wallet. First, the $6,000 senior bonus deduction. This is a new federal rule taking effect in 2026. As long as you re 65 or older and your modified adjusted gross income MAGI is below $75,000 for singles or $150,000 for married couples, you will receive an additional $6,000 or $12,000 for married couples in tax-free income on top of the standard deduction. What does this mean? It means that for many people, $6,000 of their income next year will be completely tax-free. This is a huge benefit, but most people are completely unaware of it. Check your 2025 and 2026 tax returns. If you qualify but didn't claim it, contact your accountant immediately to file an amended return. Second, the SALT deduction cap has been significantly raised. Previously, you could only deduct up to $10,000 of your state and local taxes on your federal return. Starting in 2026, that cap has been raised to $40,400. This is fantastic news for those living in states with high property taxes, such as Texas, New York, and California. If you've been debating whether to move because of high property taxes, this new rule might mean you don't have to. Third, the bear market Roth conversion strategy. With the current market correction, this is the perfect window of opportunity to convert to a Roth IRA. Take advantage of the decline in your traditional IRA's value to convert it into a Roth IRA, ensuring that all future growth and withdrawals are tax-free. But there's a state tax trap here. In states like Pennsylvania, which don't tax IRA withdrawals, the cost of conversion is $0. But in California, you'll pay up to 13.3% tax on every penny you convert. The same move, but the difference is like night and day. After all this, from avoiding pitfalls to making recommendations, from old rules to new benefits, I hope you understand that planning your retirement isn't about choosing the place with the lowest taxes, but about choosing a lifestyle that offers the best overall value. This isn't just about money, it's about the confidence and freedom you'll have in the second half of your life. Have you ever thought about what the biggest risk is after retirement? It's not a stock market crash, nor is it inflation. It's making a wrong, irreversible decision about where to settle down, and then watching your savings and dignity slowly eroded by high property taxes, insurance premiums, and medical bills. A truly smart retirement plan is one where you wake up in the morning without worrying about your property tax bill, where you can turn on the air conditioner without fretting over the electricity bill, and where, when you get sick, you can easily see a good doctor instead of waiting 8 hours in the emergency room. So, please promise me 3 things. First, don't make decisions based solely on headlines. The phrase, no state income tax, might just be the most expensive free lunch of your life. Second, do your own math. Pull all your numbers, your pension amount, your 401k balance, the size of the home you plan to buy, and your insurance needs into an Excel spreadsheet. If you can, figure it out. Pay for a fee. Only financial advisor. It's money well spent. Third, take action immediately. Review your tax returns from the past 2 years and claim back that $6,000 senior bonus deduction. That money belongs to you. If you feel today's content has helped you sort out this confusing mess and saved you at least a few thousand or even tens of thousands of dollars, then I need you to do one thing for me. Like this video, not for my sake, but to spread this counterintuitive truth to more smart friends like you who might be falling into the same trap. Subscribe to this channel, and I'll continue to be your old friend who tells it like it is. Retirement planning isn't about living to save money. It's about living with confidence. See you next time.